I've been reading about different types of reinsurance, and I keep seeing the terms proportional and non-proportional reinsurance. Could you help me understand what these mean and how they differ?
Of course. In proportional reinsurance, the insurer and reinsurer share both premiums and losses according to a set ratio. For example, in a 70-30 proportional treaty, the reinsurer covers 30% of the risks, receives 30% of the premiums, and pays 30% of any claims.
So, they share both premiums and losses in the same proportion.
Exactly. This sharing is why it's called proportional. The reinsurer participates in both the risk and reward equally with the insurer. It's often used in situations where there's a need to spread predictable, evenly distributed risks, providing balance and stability to both sides.
That sounds straightforward. So, if a loss occurs, the reinsurer automatically pays their share.
Yes, which makes it simple and efficient. This type of reinsurance is often seen in quota share or surplus share agreements. In quota share, the ratio is fixed across all policies. In surplus share, the reinsurer covers the portion of risks exceeding a certain limit set by the insurer's own capacity.
I see. And how does non-proportional reinsurance differ from this?
Non-proportional reinsurance works differently. In this type, the reinsurer only gets involved when the insurer's losses exceed a certain threshold, known as the retention limit. For instance, if an insurer agrees to cover up to $10 million in losses, the reinsurer steps in to cover anything above that amount.
So, the reinsurer covers only the excess losses beyond the retention limit?
Exactly. This is why non-proportional reinsurance is often called excess of loss reinsurance. It's typically used for catastrophic or unpredictable losses, where the insurer wants protection only against very large claims.
So, non-proportional reinsurance is more about limiting exposure to big, unexpected losses, whereas proportional reinsurance shares all risks from the beginning.
That's right. Proportional reinsurance spreads both premiums and losses consistently, while non-proportional reinsurance acts as a safety net for large, infrequent events. It's a great way to protect an insurer from major losses that could otherwise be devastating.